The differences between VEA and VXUS lie in their composition and market exposure. VEA tracks the performance of the FTSE Developed All-Cap ex-US Index, which includes large, mid, and small-cap stocks from developed markets outside the US, such as the UK, Japan, and France. On the other hand, VXUS tracks the FTSE Global All-Cap ex-US Index, which includes stocks from both developed and emerging markets, exposing investors to companies in China, India, and Brazil. In addition to the developed markets found in VEA, this exposure to emerging markets in VXUS promises higher potential returns, but also comes with greater risk. In terms of expense ratios, VEA charges 0.05%, while VXUS charges 0.08%, making VEA a more affordable option. The higher expense ratio of VXUS affects its potential returns, as the fund manager deducts this amount at the end of the year. Regarding risk, VXUS is more volatile due to its exposure to emerging markets, which are prone to fluctuations. In contrast, VEA's focus on developed markets makes it a more stable investment. Despite their differences, both VEA and VXUS are passively managed, expose investors to international markets, and are designed to be tax efficient, making them relatively inexpensive to own. Ultimately, the choice between VEA and VXUS depends on the individual investor's risk tolerance and goals. For those seeking stability and a lower expense ratio, VEA may be the better option, while more adventurous investors may prefer VXUS for its potential for higher returns.